The U.S. dollar is experiencing a significant decline, reaching its lowest value since 1973, as reported by MarketWatch. The ICE U.S. dollar index has dropped nearly 11% in the first half of 2025, marking an unprecedented decline for this period. This depreciation is largely attributed to a series of tariffs imposed by President Trump, which have undermined both domestic and international confidence in the dollar. Additionally, Trump's criticisms of the Federal Reserve have further eroded trust, with experts like Juan Perez from Monex USA highlighting the potential dangers of undermining the central bank's independence. UniCredit's report underscores this sentiment, noting the dollar's 10% loss against other currencies, while the euro has appreciated by 5%. In response to the weakening dollar and rising inflation, consumers are advised to consider financial strategies such as investing in certificates of deposit, CDs, or high-yield savings accounts. CDs offer a fixed interest rate over a set period, though they limit access to funds, making them suitable for long-term savings goals. It's crucial to understand the compounding schedule of a CD, as frequent compounding can significantly increase returns. Alternatively, high-yield savings accounts provide more flexibility, allowing withdrawals without penalties, and currently offer interest rates as high as 5.84%, according to Carinos. These financial products can help mitigate the impact of inflation on personal savings by providing higher returns than traditional savings accounts.
Salient, an AI-driven financial services technology provider, has raised $60 million in funding from prominent investors including Andreessen Horowitz, Matrix Partners, Michael Ovitz, and Y Combinator. This capital injection is set to bolster Salient's AI-powered loan servicing platform, which aims to modernize the traditionally manual and fragmented loan servicing sector. Since its inception in 2023, Salient has processed transactions exceeding $1 billion, enabling lenders to significantly reduce processing times and operational costs. The platform's AI capabilities streamline customer interactions and complex workflows while ensuring compliance, thereby enhancing recovery rates and customer experiences. The funding will enable Salient to expand its platform's capabilities, addressing more intricate servicing workflows such as credit dispute resolution and title management automation. This strategic expansion is expected to further reduce manual oversight and improve operational efficiencies for financial institutions. Salient's platform has already demonstrated substantial cost savings and operational improvements for major lenders like Westlake Financial and American Credit Acceptance. The company's vision is to establish an end-to-end AI-powered loan servicing ecosystem, positioning itself as a transformative force in the consumer finance sector.
Starbucks Corporation, SBUX, is set to release its third-quarter financial results, with analysts anticipating revenue of $9.29 billion, a slight increase from $9.11 billion in the same period last year. However, the expected earnings per share, EPS, of 65 cents represent a decline from the previous year's 93 cents per share. The coffee giant has struggled to meet analyst expectations, missing revenue estimates in 7 of the last 10 quarters and EPS estimates in 5. This performance is under scrutiny as Starbucks implements strategic changes under new CEO Brian Niccol, including the Back to Starbucks initiative and the Green Apron staffing model, which could potentially elevate labor costs by 12% in U.S. stores. Analysts, such as TD Cowen's Andrew Charles, have expressed concerns that the Green Apron model might pressure earnings through 2027, although it could eventually boost sales. Starbucks is also focusing on enhancing customer loyalty and moving away from short-term discounts, a strategy that may take time to manifest in financial results. Recent data from Placer.ai indicates a mixed trend in store visits, with some recovery signs after declines in late 2024. The market will be keenly observing Starbucks' guidance for the fiscal year and any commentary on competitive pressures, particularly as the company navigates a landscape that includes drive-through chains and at-home coffee consumption. The stock, currently trading at $93.62, has seen a modest 2.2% increase year-to-date in 2025, suggesting cautious investor sentiment ahead of the earnings announcement.
The recent integration between Hebbia's AI platform and ThirdBridge's expert network marks a significant advancement in investment research capabilities. This collaboration combines Hebbia's sophisticated AI architecture with ThirdBridge's extensive network of industry specialists, offering investment professionals a comprehensive research solution. By integrating AI-driven document analysis with expert insights, the partnership addresses the challenges of synthesizing vast amounts of data and contextual information, thereby enhancing decision-making accuracy and reducing time to insight for financial institutions managing substantial assets. Hebbia's multi-agent AI system, known as the Matrix platform, facilitates complex research workflows by breaking down intricate queries into structured analytical steps. This system's ability to process unlimited data across various formats is particularly beneficial for due diligence and financial analysis, significantly reducing manual workload for investment bankers. Meanwhile, ThirdBridge's global expert network, with its extensive library of over 10,000 annual interviews, provides unique market perspectives and industry trends. The seamless integration of these resources enables users to access expert insights directly within their document analysis workflows, streamlining processes and enriching the analytical foundation for investment decisions. This development not only highlights the growing acceptance of AI in professional finance workflows, but also underscores the strategic leadership vision focused on enhancing customer-centric research methodologies.
The latest round of U.S. China trade talks in Stockholm, involving U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng, aims to address ongoing tariff tensions between the two largest global economies. The discussions are critical as they could set the stage for a potential meeting between U.S. President Donald Trump and Chinese President Xi Jinping. The talks follow a series of negotiations across Geneva and London, focusing on extending a 90-day pause on tariffs that had previously escalated to as high as 145% on Chinese goods and 125% on U.S. goods. Currently, tariffs have been reduced to 30% and 10% respectively, but without an extension by August 12, these could revert to previous levels, impacting global markets and trade flows significantly. The trade negotiations are part of a broader U.S. strategy to address its trade deficit, which reached $904 billion United States dollars last year, with a substantial portion attributed to China. The Trump administration's approach involves leveraging tariffs to renegotiate trade terms, aiming for a more balanced economic relationship. Structural reforms, such as increased U.S. manufacturing and reduced Chinese overcapacity, are seen as essential for long-term stability. The outcome of the Stockholm talks will be closely monitored by businesses and analysts, as it may provide insights into future U.S. China economic relations and the possibility of a Trump-Xi summit, which could further influence global economic dynamics.
OKX, a prominent global crypto exchange, has announced the launch of regulated retail derivatives products in the UAE, marking a significant milestone in its regional expansion. This development makes OKX the first global exchange to offer retail futures, perpetual contracts, and options under the UAE's regulated VARA pilot framework. Retail traders in the UAE can now access institutional-grade derivatives trading with up to 5x leverage, providing them with greater flexibility and a broader range of trading strategies. This launch underscores the UAE's commitment to fostering a progressive regulatory environment for digital assets, positioning it as a leading hub for crypto innovation. The introduction of these regulated derivatives products is expected to enhance market participation by empowering retail traders to better manage risk and respond to market trends. OKX's collaboration with the Virtual Assets Regulatory Authority, VARA, reflects a strategic alignment with local regulatory guidelines, emphasizing investor protection and market integrity. As part of its regional strategy, OKX is investing in local talent and educational initiatives, ensuring that traders have access to necessary tools and resources for informed trading. This expansion follows OKX's receipt of a Virtual Asset Service Provider (VASP) license in 2024 and highlights the UAE's growing influence as a forward-looking jurisdiction in the digital asset space.
The article discusses a strategy for generating $1,000 in monthly passive income through an ETF-only portfolio, emphasizing the potential for financial independence. It highlights 3 specific ETFs, WisdomTree U.S High Dividend Fund, DHS, NEOS Nasdaq 100 High Income ETF, QQQI, and iShares Flexible Income Active ETF, BINC. These ETFs offer exposure to various markets including stocks, bonds, and options premiums, with a focus on high yields and monthly payouts. The combined yield of these ETFs is 6.89%, requiring an investment of $174,165 to achieve the targeted monthly income. Each ETF has unique characteristics. DHS focuses on high dividend cash cow businesses with a 5.41% yield. QQQI provides exposure to the Nasdaq 100 with an options overlay yielding 14.65%, and BINC offers stability through bond investments with a 6.36% yield. The article notes that while high-yield ETFs can offer significant income, they often come with higher expense ratios and may limit capital appreciation potential. The strategy is geared towards investors seeking steady income streams, particularly those planning for retirement or aiming for financial independence.
Rosen Law Firm has initiated a class action lawsuit against Replimune Group, Inc., Nasdaq, REPL, alleging that the company made materially false and misleading statements about the prospects of its IGNYTE trial. The lawsuit covers securities purchased between November 22, 2024 and July 21, 2025. The plaintiffs claim that Replimune overstated the trial's prospects, which were later deemed inadequate by the FDA, causing investor losses when the true details emerged. Investors who purchase securities during this period may join the class action to seek compensation. The lawsuit highlights the importance of transparency and accurate reporting in clinical trials, especially for companies in the biotech sector. Misleading statements can significantly impact investor trust and stock prices, as seen with Replimune. The case underscores the role of law firms like Rosen in safeguarding investor rights and ensuring accountability. Rosen Law Firm is known for its expertise in securities class actions, having secured substantial settlements in the past, which could reassure potential plaintiffs of their capability to handle such cases effectively. Investors have until September 22, 2025, to move the court to serve as lead plaintiffs in the case.
EQT, through its EQTX fund, in collaboration with the Canada Pension Plan Investment Board, CPP Investments, has announced the acquisition of NEOGOV, a leading provider of human resources and compliance software for U.S. public sector agencies, from private equity firms Warburg Pincus and Carlyle. NEOGOV, founded in 2000 and based in El Segundo, California, supports nearly 10,000 public sector organizations across North America with its cloud-based solutions that manage the entire employee lifecycle, from recruitment to compliance management. This strategic acquisition aims to enhance NEOGOV's growth and innovation, particularly in advancing product innovation and AI capabilities, leveraging the expertise and resources of EQT and CPP Investments. The transaction reflects the rising demand for digital transformation within the public sector, driven by the need for improved efficiency and regulatory compliance. It also highlights a trend of private equity investment in SaaS companies that support critical public administration infrastructure. The deal, which is subject to customary conditions and approvals, is expected to close in the coming months. Post-transaction, EQTX will be 60 to 65% invested. The involvement of prominent financial advisors and legal counsel, such as Moelis & Company LLC and Jefferies LLC, underscores the deal's significance in the private equity landscape. CEO Shane Evangelist of NEOGOV emphasized the shared vision with EQT and CPP Investments to advance the company's market position and operational capabilities positively.
The recent insights from Cindy Leo, co-founder of Drift Protocol, highlight the evolving nature of the cryptocurrency market, particularly through the lens of meme coins and decentralized finance, DeFi. Leo argues that meme coins, despite their whimsical origins, reflect a maturing market where users can organically create and trade tokens, indicating a growing sophistication in the crypto space. This maturation is underscored by Drift Protocol's substantial growth in on-chain perpetual futures trading, with volume increasing fivefold recently. The improvements in user experience and liquidity on decentralized exchanges, DEXs, like Drift, have made trading more comparable to centralized exchanges, CEXs, overcoming previous challenges like onboarding and user interface issues. Drift Protocol's success is attributed to its commitment to Solana's Layer 1 blockchain, which offers a trustless and verifiable environment, ensuring secure and accessible funds. Leo emphasizes the importance of censorship resistance and the efficiency brought by Drift's just-in-time JIT liquidity model, which enhances trading by allowing market makers to fill orders directly, bypassing gas costs. The role of meme coins in driving perpetual futures volume on DEXs is seen as sustainable, with Leo predicting that liquidity will consolidate around major chains with robust infrastructure and liquidity. Drift's focus on cross-collateralization and organic retail flow has boosted its total value locked and trading volume, setting it apart from competitors who have shifted away from ecosystems like Solana.